This is Mark Anthony with Mercury Time Price Analytics. Welcome to our end of day video. We're trading S&P and NQ futures Thursday, July 16th. So I got an email today from a trader, number of years experience, just frustrated, asking how in the world do you trade these markets? They're random. We get deep, fast, violent moves interspersed with random choppiness like we had today. Here's the thing. Right now, the market is confused. It's trying to figure out whether the next 50 handles are up or down. Now, that market confusion is exacerbated by the fact that we've got historically low liquidity. Why is that? Well, because a huge percentage of the volume, I've seen estimates over 70%, close to 80% of the volume in the market in 2018, 2019 was corporate buybacks. Well, many companies have reduced or eliminated corporate buybacks. So that gives you a equity market as a whole and a futures market specifically that has very low liquidity. That exaggerates these up and down moves. Plus the fact that we're back to one of the key levels that the market wrestled over in December. I'm going to show you a chart in a minute. It is amazing the number of algorithmic pivots, key levels, that are between 3240 and 3140. As a matter of fact, let's take a look at that chart now, because that'll be a segue into why these markets are a little bit different, but I'll share with you some of the keys that will absolutely help you. Let's take a look at our first screenshot. Now, this chart, let me make sure this is the right one, gang. Hang on a second. Yeah, this is the right one. Okay. So you see three different types of pivots on this chart. You see our Mercury bands. The Mercury bands, there's a short cycle and a long cycle. The short cycle is a 5-day look back. The long cycle is a 10-day look back. And so you can see short cycle pivots here in cyan and long cycle pivots in green. What you also have on here is Mercury band extensions, upper and lower extensions. And then you've got these really cool things that we call XSV pivots. You've got an XSV4 and XSV2. The XSV2, it's a time cycle that's over 2 hours. The XSV4 is over 4 hours. And I note on here the date that this algorithmic pivot goes back to. So for example, here at 3217, you have an XSV4 pivot over 4 hours. It's not 4 hours on the nose. It's more than 4 hours. 3217, that goes back to June 8th of this year. Up here, we've got an XSV4 pivot, 3237 from February 24th, 3240 from May 25th. We've got this important one, 3183 from December 15th of last year. We've got one down here at 3145. We've got another one here at 3167. You get the point. There's every couple handles there is a historically important pivot level or a very important pivot level from the last few months since the market's been wrestling with the fallout of the coronavirus. And then you have these angled tan lines, which are algorithmic regression lines. That's a proprietary formula. I haven't seen anybody else that does this particular type of work. But what the algorithmic regression lines are these are angled lines. They're based on a time price formula. And by time price formula, what I mean is we take multiple algorithmic time cycles and we look at prices over a number of periods of time and different time cycles, and in our formula shows where price and time intersects. If you're a student at WDGAN, you know what I'm talking about when I say where time and price intersect. Look at how beautifully these algorithmic regression lines cut through price. I'm going to show you a couple more charts specifically with the regression lines in a minute. But the point is, you take this 100 handle block of price between 3240 and 3140, And it is astounding the number of key levels. Now, when you get a market that's got good liquidity, these algorithmic pivots tend to act as fairly reliable support and resistance. And here's the important point. When you have a market that has low liquidity, these levels that would normally be, please listen to this, these levels that would normally be fairly reliable support and resistance become very binary. Either they will act as support or resistance, or they will price will just crash right through them. There is no in between. So very binary. The levels either act as support and resistance like you would imagine, or you get days where price just crashes violently downward and upward. And I'm going to show you a chart in a minute, a wider view that shows you this week and last week that'll blow your mind. But this is why this market is so difficult. Now, back to the original question. How do you trade thin markets? First of all, you reduce your position size. You want to trade much fewer contracts than you normally trade. Secondly, you have to take partial profits very quickly. Now, understand first and foremost that futures trading involves significant risk. It may or may not be appropriate for your account. You have to decide that. We recommend you consult with a financial advisor. But if you have an appropriately funded account, we recommend trading in a number of contracts divisible by 3. Now, before I share with you why that's important, please understand that you don't determine your trade position size by looking at how many is the maximum number of contracts your broker will let you put on. Professional traders never risk more than a small portion of their account at any one trade. So whether you're talking about E-minis or micro minis, if the maximum amount of contracts that your broker will allow you to put on based on margin requirements is 3, you don't trade 3. So assuming that your account and risk tolerance and where you are in your life is appropriate for trading, for example, 3 E-minis or 3 micro minis, that's what we're talking about, but I wanted to get that disclaimer out of the way first. So let's say you're trading a 3 lot. In thin markets like this, what you have to do is you have to take 1/3 of your profit, one of those 3 contracts, very quickly. In a market like this, we're talking like 3 handles. So if you get in a trade that moves 3 handles in the direction of profit, if you're trading a 3 lot, you take profit on one of them. We call that your first third. You take your first third for 3 handles. Now, what you do after that is critically important, because after you take that first third, you need to move your stop either to even, meaning the price that you got in the trade, or at the very most, give it an extra handle. But that's it. So that way, if you're trading a 3 lot and you get a +3, you take your first third. So that way, even if you get stopped out at even, you've booked a couple handles, or even if you put that stop 1 handle on the other side, you get stopped out, you lose a handle on those other 2 contracts, you've still made 1 handle. So it's very important that you take that first third quickly, and then if the trade continues to move in the intended direction, then you want to trail a stop. And what you cannot do, the cardinal sin, is after you've taken that first third, don't let price go back against you, and as it starts to get close to taking your stop out at even, don't move your stop, ever. Because, moving stops is like eating Doritos. You can't have just one. You'll move the stop, then you move it again, then you move it again, then you move it again. And then a trade where you had 3 handles of profit on the first third, on that other 2 thirds, you give back 8, 10, 15 handles. That's how you blow up a trading account. So don't ever move your stops. You can always re-enter a trade if conditions are appropriate, but don't be moving your stops around. But those are the things you have to do. You have to be very diligent about taking that first third, and then you trail a stop down. Let's say you get a +3 on the first third, then 6 or 8 handles, take the middle, and then the last one, the last third, that's your runner. And by all means, after you take that middle third, you 100% of the time move your stop to break even. So that way on that last third, that runner, you're not going to do any worse than break even on that last contract. You've profited on the other two. The other thing is you have to be patient. And one of the best ways to be patient is that little thought that comes into your mind when you say, okay, well, this is a level I may be interested in. Take whatever that feeling is for you in a normal market with good price discovery and wait. Because if you wait till the second or third time you see a level a little bit farther, it's probably going to be a better entry, because this market, and what I mean is this market is moving up and down more than you think. If you're of the mind to short the market, well, instead of shorting it here or here, give it a little bit more and let it go up to a higher level if your intention is to short. If your intention is to buy pullbacks, take whatever your normal level is where you would normally get that feeling to take that long position and give it a little bit more time, because you can see what happened here on Monday. If you thought this level was going to hold, it didn't. Nor did this, or this, or this, or, I mean, all the way down. You know, so you had a move that topped out here at, call it 32.25, that went down to 31.40 in no time. So you can trade illiquid markets if you diligently take profits, keep tight stops, and then don't let a profitable trade go the other way. Now, I promised I'd show you a couple of charts that would blow your mind. I'm going to show you a chart that has less levels on and just focuses primarily on these regression lines. And I'm going to show you a zoomed in view and then a wide view. So here you have a zoomed in view, and this is the end of the day today, Thursday the 16th. And you can see, again, the tan angle lines are the algo regression lines. So you can see, and what happens with these regression lines, price fights over it, and then it tends to break through, and many times reverse. So you can see times like down in here, where it fought back and forth above and below this regression line, then it released, and then it came back up. And what that tells you, when you lose one of these regression lines, then you get a squeeze. One of the most devious things that the institutional algorithms will do is they'll set these traps, and these traps are defined by these same regression lines that you're looking at right now. So you take this right here, and this level was, call it 32.12, 32.13. You get this spike up, back down, up again, and then what happens when that regression line breaks? Boom. You have the same thing here. Price fights over the regression line, it releases, and when it comes back through that regression line, it's going to go. These regression lines quite simply define places where the institutional algorithms will set traps. I call it an algo hook. So take this example right here, which was Wednesday. You get this little move above, it runs stops, and then it reverses. Now, there's other times where these regression lines will just be pinpoint, and you'll get reversals almost to the tick. You saw it here and here. Today, on the other hand, Thursday, July 16th, it fought up and down over this regression line. Now, one of the other things that was amazing today, this is our daily algo bull bear pivot. We put this out each morning about an hour and a half before the day session opens. That is the single most important price on the board every day. So this is this morning's 32.03. Look at how many times, and again, this was released at 8 o'clock. Look at how many times this fought up and down above and below the daily bull bear pivot. That doesn't normally happen. In fact, it's extraordinarily rare, because usually what happens with this daily bull bear pivot is when price comes from one side to the other, it runs. If price is above the bull bear pivot and that gives way, price will run lower. If price is coming up into the bull bear pivot and that resistance gives way, it runs higher. This nonsense you saw today is very, very rare, but let me show you why it happened. I'm going to take this same chart and we're going to pull the chart back out and show you a wider view. This is the chart that blows me away. So now we've taken those same regression lines you just looked at, but we've zoomed out, so now you can see back to last Tuesday. Now, you talk about a market that's confused. Last Tuesday, sharp move down. Last Wednesday, sharp move up. Last Thursday, sharp move down. Friday, you had both, sharp move down and then a brutal short squeeze. That was Friday. Monday, you get a move up, and then you got the mirror image or a duplicate, excuse me, of Friday. Move up and then down. So Tuesday, let's just take this back to Thursday, because this is just this makes the point of why today was so choppy. Thursday, you get a sharp move down. Friday, you get a sharp move up. Monday, you get a sharp move down. Tuesday, you get a sharp move up. Wednesday, you get a pretty decent move down. So from Thursday, big move down, and it alternated days. Down on Thursday, up on Friday, down on Monday, up on Tuesday, down on Wednesday. So after those 5 days of up and down, well, it's natural that you're going to get a little chop, because as I mentioned earlier, this tape right now is trying to figure whether the next 50 handles is up or down. Tomorrow, the 17th, is monthly options expiration, and we may get another day of chop. I mean, you just never know. Every once in a while, you get an OPEX that runs when the options ARBs lose control of that collar, so to speak. But there's a lot of options activity around 3,200, so it's possible tomorrow that rallies above 3,200 are going to get sold, and moves below 3,200 are going to get bought. We'll have to see. But tomorrow is OPEX, so there is the potential that we get another one of these really choppy days. But if you stick to your discipline and you go back to what I mentioned earlier about trading thin markets, and that is you take that first third very quickly, 3 handles is a good benchmark, then either move the stop to break even or maybe give it 1 extra handle, and that's it. You can trade these kind of markets, but you have to be patient. You have to trail your stops, and most importantly, and I've got to repeat this again, don't move your stops. In a market like this, with this kind of up and down, if you're continually moving your stops, you're going to have a really bad day. So just keep if you're trading these markets, and look, deciding not to trade on a particular day is sometimes the best strategy. And so always keep in mind that you can make the choice to not trade until market conditions become more favorable. So please be careful. Please trade according to your account size and risk profile and where you are in your life and what goals you're trying to accomplish. If you have not been to our website, it's mercurysignals.com. We've got a subscription trading service where we give you these metrics in real time. So you're seeing a live chart like this with everything from long-term metrics to short-term metrics to our upper and lower bias pivots to our algorithmic oscillators. Whether you're a short in and out trader, an intermediate trader, a long-term trader, we give you everything that you could possibly imagine. And this is just one of the 2 live chart screens that we give you access to. And so if you haven't been to our website, it's mercurysignals.com. Just click on subscriptions, and that will give you the current rates. We bill bi-weekly, not monthly, so that way you're not locked into paying a month at a time. And the cool thing about our system, because we just feel like this is the right way to run a business, is we give you the best of both worlds. And what I mean by that is we bill you every 2 weeks, not monthly, so you're not committed long term. And even though we give you that flexibility that you can quit anytime you want, any 2 weeks, on the other hand, we give you a lifetime rate lock. So we guarantee you that your rates will never go up. There is no software to download. This runs on a live chart on Zoom, so all you need is a free Zoom account to see the live chart. So you're not spending money on software not committing to buying software that you may or may not like using. I want to close this video the same way I always do, and that is by sharing this. Things are pretty difficult for a lot of folks right now. There's a very difficult time. It doesn't matter where you live. It doesn't matter whether you have money or you don't. Things are difficult if you have kids, even more so. If you're feeling lonely or upset or dealing with depression or anxiety, now more than ever, please understand that God loves you and He's there for you. And He wants to have a relationship with you. So if you've never thought about inviting Jesus into your life, I would ask you to strongly consider that. God will always be there for you. He will never leave you. He will never forsake you. And whether you ever go to our website or ever consider our service, what I just mentioned is more important than any of the stuff we've been talking about regarding the markets. So with that, I thank you so much for your time. God bless you. God bless your family. And we hope to see you back again real soon.